please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's get in some market opinion. Earlier this morning, we caught up with Sunil Garg, the head of international equity research at JPMorgan, from the sidelines of the India Investor Summit, which is underway in Delhi, to talk about the performance of emerging markets as well as the outlook for the Indian market. And Sunil actually mentioned a very important point, that they have cut the target now for the MSCI Emerging Market Index. Hear him out.
We've lowered our estimates in terms of target price for MSCI Emerging Market Index and also some of the EPS numbers. But the fact remains that emerging markets are very cheap, and in fact they're trading at a much wider discount to historical averages, and that at least provides a value floor in emerging markets. So overall we are positive. I think the big driver here, it's going to be China, because China has been a massive underperformer. So it's not just some of the Latin American currencies that have been weak, but it's China's equity market that has been dragging down EM performance. We've had a very strong performance from here. I think in terms of where our Nifty targets are, it's probably a relatively modest upside at this point in time. If you look at some of the high frequency data points coming through, whether it's PMI, whether it's rainfall, whether it's the pressures from oil prices, I think these are going to be acting as headwinds, and we think the consensus earnings estimates are probably a bit too rich. They're about somewhere between 21 and 25% for either MSCI India or Nifty, and we think it's going to be closer to 15%. We actually think that higher bond yields are a sign of confidence, and typically, historically, and particularly in developed markets, they've been associated with better equity markets rather than the other way around. Overall, emerging market positioning at the moment is light, and I think India is, as I again mentioned earlier, has been one of the stronger outperformers. So there's clearly a possibility that as investors get more comfortable with emerging markets, it rotates into markets that have massively underperformed.
Well, the rupee had recovered earlier this morning from near 73 levels that we saw yesterday. Let's hear out what Jahangir Aziz of JPMorgan had to say on the rupee trajectory and what he expects from the Reserve Bank of India in its October policy.
There are much simpler solutions to these problems. There is much simpler explanation to where we are, why we are. But if we do not want to go with these simpler solutions and simpler explanations, instead we want to get tangled in the weeds with exports, imports, oil prices, we are going to come up with these kinds of very tangled solutions and tangled views. There is a very simple thing, and there is very little controversy about it. There are two reasons as to why the rupee is under pressure, like any other current account deficit. The current account deficit is rising, and global financial conditions have actually tightened through April till July. In August was very different. Then in August, emerging market risk was being reassessed. If you've made up your mind, I don't know whether RBI has made up his mind or not, but suppose they have decided that they're going to hike in October 5th or 6th, whenever the policy date is, then it's much better to do that rate hike now, in fact last week, in fact the week before that, then delay it till October. The effectiveness of that rate hike goes away, diminishes, the longer that is delayed. And I don't see these artificial things about policy review October 5th, therefore I can't hike before October. Those are just, artificial restrictions. So if you're, I'm not so much worried about how many rate hikes as I'm worried about how quickly the rate hikes come in, because the more you delay it, the larger the rate hikes always end up being.